to do everything we can to protect and diminish that from ever happening again. But as I talk to other CEOs, when you run big organizations, occasionally people do bad things, and we're going to try to make sure we protect as good as we can against that.
Wanted to touch on the announcement you made to our Squawk Box colleagues in Davos about not taking on any future IPOs unless there's a female representation or minority representation on the boards. Have you made assessments as to whether that could lead to you losing business? And if it does do that, would you still proceed with the policy?
Well, we thought a lot about this over a long period of time. And to be perfectly honest, Wolf, I'm amazed in 2020 that Goldman Sachs has to say that they don't want to take a company in the United States or Europe public without at least, one diverse board member going sometime in 2021 to 2 diverse board members. There's no question that diversity on boards benefits the performance of companies. And, I'm hopeful by our taking this action, some of the companies that are preparing to go public in the future that haven't really thought about the structure of their board and how important it is in the context of the IPO will start thinking about that earlier. And I think we're very well positioned with a reservoir of qualified diverse candidates to help companies have opportunities to talk to and network with people that could join their board. I said on CNBC when I was in Davos that we might lose some business, but we think this is the right thing to do. So I stand by that. We might lose some business, but we think it's the right thing to do. But this is good governance. It's common sense. And, I think based on the response we've received, overwhelmingly, people agree this is the right thing.
As you said, people do agree it's the right thing. And I wonder whether you would consider in the years ahead taking it a step further and applying it to listed companies who you bank with and do business for as well. Is that something that could come next?
Look, I think we sit in a position in markets in the capital formation process where we want to use our platform to help the communities we operate in move in the right direction. We want to use the position that we sit in with respect to governance to see that governance is always improving, for public companies. In the context of that, we'll always think about ways that we can do that and advance what's a healthy dialogue on capital markets, capital formation, business governance, et cetera. We don't have any plans to do anything differently. But this was one that it was so obvious that it needed to be advanced and it could be advanced. And I do think that most companies, as they get into the public market, are already doing this. It's that transition period, especially for a lot of the private companies as they're transitioning, where I think this deserves more focus.
I want to ask about the coronavirus. So where do things stand? Goldman Sachs has got a big footprint in China, Hong Kong, and the region. What's your latest policy for your workers there?
Well, first and foremost, we're very focused on it because we have a couple of thousand people, right there in the region, and we're obviously very concerned about those people, about their families, et cetera. I think it's too early to say, where this will go. We obviously have a lot of people working from home and are, restricting travel like many companies, but we're watching very, very closely and are obviously concerned for our people and doing everything we can to help and protect.
Just one final question on the Fed. Just kept rates on hold, of course. As you look at the U.S. economy and the strength of it, if you had to guess now, which is likely to be the direction of their next move in interest rates?
Boy, I really contemplated that. And by the way, as you said, of course, the Fed didn't move today. Well, I knew the Fed wasn't going to move today, and until we sat down, because I've been a little bit busy today, you told me that the Fed didn't move today. When you look out, we're still pretty constructive on economic growth. Our economists, putting the virus aside for a moment, which obviously could affect both global and U.S. growth, are still a little bit above the consensus on U.S. growth, a little bit above 2%. At the moment, as I sit and look at where we are, I don't think we're going to see the Fed move until at the earliest late in the year or sometime early next year. And so I'm not going to speculate because there are a lot of variables that can change that. But I think for the moment, we're going to have relatively stable environment around monetary policy for at least a few quarters.
Well, David, congratulations again on a great start to the year.
Thank you.
Share price outperformance year to date, and thank you for having us along.
Absolutely. Thanks for having me on, and also thanks for spending the day here and really listening to the presentation, listening to our story. We're hopeful that this helps people have a better understanding of what we're trying to do with the firm.
And I think still time for me to join the deep dive on risk management and compliance. David,
please,
pleasure as always.
Thank you very much.
Thanks so much, guys. I'll send it back to you in the studio.
All right,
that sounds stimulating.
keep us posted on that, Wilf. Joining us for the hour, Karen Feinerman's here, CEO and co-founder of Metropolitan Capital Advisors. A lot to choose from today, Karen, whether it's The Fed, earnings, we got some intraday volatility. What do you think?
Right. Well, I'm pretty positive overall. I feel like, the economy's in decent shape. I feel like the Fed is obviously pretty dovish, right? I feel like there is a chance that we see some green shoots elsewhere in the world. I think Powell actually alluded to that. That would be good. And I think that coronavirus will be fairly fleeting. So all of that together makes me feel somewhat positive. And I'm always long. That's just the mandate. I'm always long. But so a week like this, I'm buying some Yum China, buying some BABA and selling some hedges, which makes me nervous to sell them. But just too high, and now the VIX is kind of in no man's land. Let's see where it shakes out, but I'm feeling pretty good overall.
All right, we're going to delve into more of your ideas over the next few minutes. As Karen said, Fed did keep rates unchanged today. Let's bring in Steve Leisman, who was in the room, asked about potential taper tantrums down the road. Hey, Steve.
Morning. Good afternoon, Carl. I can agree with what Karen said, that the Fed is definitely in a dovish mode. I think one way to think about it is, if it was sitting in a room, it'd be a lot closer to the cut button. It'd have to kind of get up and walk across the hall and open a door and go into another office where the hike button is. It's a little bit far. It's much further from that. And it was interesting what Powell did say, that he saw some of the trade tensions or uncertainties easing, but he said they still exist and they're still around, and he's kind of reserving decision as to whether or not there's going to be a business investment rebound because of the trade deals that have been announced and signed. But he said, hey, there's a new one, which is the coronavirus. I don't know if we have that sound there, but he did talk about that quite a bit, where he said, hey, it's something we have to watch. Didn't want to get ahead, I think, of other authorities when it came to it, Carl. But ultimately, he said that's another thing we're going to be watching. And the statement itself said global developments were something the Federal Reserve had concerns about. In addition, there was this downgrade to household spending that, not a big deal. It said it had been strong, and the consumer has been strong. Now they see it growing at a moderate pace, and that's something worth watching. So again, the risks when you listen to Chair Powell and when you read the statement look to be much more to the downside than to the upside.
Steve, on the balance sheet question, repo, I think, was the word. Someone should go back and count how many repo questions there were, which is crazy if you think about it. But what did we learn about balance sheet expansion and what the Fed's plans are?
Well, they're going to continue at least through May. There is some discussion, agreement to reduce that balance sheet expansion over time. We didn't exactly get a number. We got some indication of where the Federal Reserve is heading, and he didn't really bite on my question about whether or not he thinks it's essentially juicing the stock market. He said a lot of things affect the stock market. QE is not our intention, even though it's a very large balance sheet purchase, he said. And so he's going to leave it at that. And I asked him, as Carl said, about the possibility of a taper tantrum. And I know some members of the Federal Reserve are concerned about that, but that does not seem to be a concern right now of the Federal Reserve Chairman.
Steve Leisman, thank you.
Pleasure.
For more, we are joined by Paul McCulley, former PIMCO chief economist and senior fellow at Cornell University, and Sarah Bloom Raskin, former Federal Reserve governor and former deputy Treasury secretary. Good to see you both. Paul, watching this together, this is like watching how normal people watch sports games.
Exactly.
You were cheering and you were loud. Why did you think Powell did such a good job?
I think he had two essential messages that he wanted to communicate. One was that he really does want to get inflation to 2%, not near 2%, but 2% or higher, which is flashback to where he was in December, where he said basically no tightening unless 2% gets realized, and he pounded the table about that. So essentially the committee is pounding the table in sympathy with him back in December. So I think that was really important. It just changed a simple word in their statement from near 2% to 2%. And then the other thing he wanted to do was really for wonks like me, which is to walk through the details of exactly what they're doing with their balance sheet. And the key takeaway from that is that he really wants administered rates to be the point of the spear in implementing monetary policy. And he really wants to get out of day-to-day open market operations. But they can't get there to getting out until they get reserves back up. So essentially it was 2%, damn it, I'm going to get there. And the other was that he wants to get out of high velocity day-to-day operations by the New York Fed, and he really wants administered rates to carry the load.
Sarah, when he talks about repo operations receding, trying to remove unnecessary volatility, how much is he willing to tolerate, and what is an equity investor supposed to think about that? Is it a classic sort of not a sell in May signal, but a sell in April signal?
Right. So I think while there were tons of questions on the plans that the Fed has in terms of removing the massive accommodation that it has made since September, I mean, accommodation in the realm of $60 billion of Treasury bill purchases per month, which is really quite extraordinary. There is, of course, a concern that this can't or shouldn't go on forever. And so his signals that there will be some kind of tapering back of this accommodation, I think, is a signal that he wanted to send. He tried to keep his options open in terms of definite timing, and yet at the same time, I think he wants to signal to markets, and particularly to participants in the repo market, that this is going to happen, that he feels that this can't go on forever, and that there's going to need to be some paring back.
You know, what he says and how the market interprets it, Sarah, are different things. I mean, he can say this is not QE, this is not meant to stimulate asset prices, this is technical, this is plumbing, but forget it. I mean, investors sort of have their own ideas about that. So, I mean, what's the reckoning there?
Yeah, and I think you're exactly right, Sarah. I mean, he is using that term technical over and over and over again, hoping that people will kind of tune out and think that this is something that is pretty benign. And yet, I think that has, you know, that's still, there's some questions on that, because again, it has been a massive accommodation. It has done it through, you know, again, through tools different from the QE tools, right? Again, it's just Treasury bills. It's not going into longer term Treasury securities. And so that is a difference. And yet, from a market standpoint, you have to look and say, but wait, is the effect in essence the same? And that, I think, is what a lot of equity participants are asking. And with that question, I think they continue to wonder whether or not this is some kind of, you know, QE in the shadows.
Paul, he talked about this being a one-time thing in December. It was about corporate tax season. Then it was about year-end. Now it's about regular tax season. If March comes and there's no exit ramp in view, the market's going to have some questions, right?
I think the market does now and will in the future, because the market really hasn't taken on board the core thesis that he's articulating, is that in shrinking their balance sheet, they overshot ample reserves. They simply overshot. So they want to get back to ample, and then once they get to ample, and they're doing it at $60 billion a month, then they want to go to just generic growth for currency and circulation and other sorts of things. So I think he was incredibly clear on the plumbing issues that he's dealing with, but the marketplace wants to look at it as a shadow QE.
I mean, do you care, Karen? Do you care what the balance sheet is doing?
I mean, I care that people care, right? You know
Exactly,
what I mean?
exactly.
Right. So if I think, all right, people are going to react really negatively, like you said, doesn't matter what he calls it, doesn't matter, the reaction is going to be negative. I don't know, can he do that, though, in a vacuum? Does it matter what the ECB is doing? How much does that dictate his policy?
I don't think the ECB really has anything to do with what they're doing here now. This really is a plumbing issue. He wants to have enough reserves in the system so that you get no more repo scares. And the core issue is that they set rates through the administrative process now with interest on reserves. That is the bedrock. And open market operations really are fine-tuning at extremes. He doesn't want to do open market operations on a daily basis like they did when I was a young man.
Wonky. Paul, Sarah, thank you very much, guys, for your time today. When we come back, we'll bring you some uninterrupted coverage of the final minutes of trade when we take you inside the market zone. Don't go away.
Imagine traveling hassle-free with your golf clubs. Now you can with ShipSticks.com. No more lugging your clubs through the airport or risk having your clubs lost or damaged by the airlines. Sending your own clubs ahead with Shipsticks.com makes it fast and easy to get to your golf destination. With just a few clicks or a phone call, we'll pick up and deliver your clubs on time, guaranteed, for as low as $39.99. Shipsticks.com saves you time and money. Make it simple. Make it Shipsticks.
Come and get it like Introducing the Right Now sale from Vistaprint. With up to 50% off almost everything, it's the perfect opportunity to try a fresh new look. Do something a little different. Build an even better brand. With up to 50% off almost everything, you can save big right now. Use promo code SAVEBIG and own the now during the Right Now sale from Vistaprint now through January 31st.
Wondering which credit card is right for you? Introducing CNBC Select, the authority on all things credit cards. We do the research, you reap the rewards. Head on over to cnbc.com/select and take
whatever job you're searching for, you can find it on LinkedIn. First jobs, flexible jobs, keep me out the cold jobs, advertising jobs, accounting jobs, HR, PR, even ER jobs, East London jobs, West London jobs, extra hour in bed jobs, startup jobs, late start jobs, get home in the daylight jobs, banking jobs, building jobs, flexible working on a Friday jobs, or even voiceover jobs, which is how I ended up recording this ad. Search millions of jobs on LinkedIn and find one meant for you.
Keys. Check. Phone. Check. 70s playlist downloaded? Check. Nice. There's one more thing you should check before you leave. Your travel. There's a new cycleway under construction between Kensington Olympia and Brentford Town Centre, so expect delays due to lane closures at the junction of Kew Bridge Road and Chiswick High Road. Plan ahead at tfl.gov.uk. To the Mayor of London and TfL, every journey matters.
What do advisors look for in an ETF?
Don't just track an index. Help me meet a client's need.
Is the fund built to sell or built to last?
ETFs are only part of a portfolio, so make it easy to explain.
Give me a quality fund that helps me get clients closer to their goals.
FlexShares ETFs are designed and managed around investor objectives, so you can advise with confidence.
Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to flexshares.com for a prospectus containing this information. Read it carefully.
You should be mad they gave this guy a promotion. You should be mad it forced camaraderie. And you should be mad at tech that makes things worse. But you're not mad, because you have E-Trade, whose tech makes life easier by automatically adding technical patterns on charts and helping you understand what they mean. Don't get mad. Get E-Trade's simplified technical analysis.
The Market Zone is sponsored by E-Trade. Get $100 on us when you deposit $5,000.
10 minutes left in the trading day. We're entering the Market Zone, commercial-free coverage of all the action going into the close.
CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day as always. And today we've got Karen Feinerman from Metropolitan Capital Advisors here as well. Let's kick it off with GE, General Electric. Seema Modi has more on the earnings story. Seema.
Hey, Sarah, let's take a look at the stock right here at Post 5. Nearing the $13 mark, now up over 10% as the company continues to scale down its debt and grow its industrial free cash flow. That's building investor confidence in CEO Larry Culp, who was brought in late October of 2018 to really turn around the struggling industrial giant. Still has a way to go, but encouraging results to say the least. And despite the grounding of the Boeing 737 MAX, which GE manufactures the LEAP engine for, CEO Larry Culp telling me this morning that GE continues to grow its aviation business, and it's seeing increased demand from Airbus and the U.S. military. The stock up 10%, best day since October of 2019. Guys, back to you.
Seema, thank you. Karen, thoughts on GE? Are you a buyer?
I'm not a buyer. I mean, that was what everyone was looking for, right? Cash flow. And when you have this balance sheet and you need to be plugging away at improving it, that's really important. So kudos to him. Very impressive.
Yeah, sort of minimize the possibility of adverse surprises coming from non-core parts of the business, and then just sort of a convalescence in financial discipline is the story. It's probably got a little work to do, though, around $13 a share. If you look, that's kind of where it really fell off a shelf. So we'll see if chart-wise it can get further progress.
Right.
course, heading into a headwind of sorts on aviation. Boeing, of course, did post its first annual loss since 1997. Phil LeBeau has been covering that all day and from the beginning. Phil?
Carl, the numbers from Boeing were as expected. The fourth quarter, a mess, and nobody expected anything more. As you mentioned, the company did post its first net annual loss since 1997. $2.33 a share is how much the company lost in the fourth quarter. The numbers within the numbers, it's all about the 737 MAX. The cost now rise. Basically, they almost doubled. It's now up to $18.6 billion. So why is the stock moving higher? Well, it's because CEO David Calhoun reaffirmed his guidance of a mid-year ungrounding of the MAX, and he downplays any suggestion that they are sandbagging their estimates in terms of bringing this plane back.
You can't sandbag in a situation like this. I have to answer to our employees. I have to listen to our employees. I simply have to give them the time they need to do the natural discourse that occurs in a big, complex certification process. And that's what we've provided for. Nothing more, nothing less. So I believe we can do it. And then the only other comment I have to make, and I will always make, I do not and will not control this timeline.
One other note from our interview with David Calhoun this morning, as you take a look at shares of Boeing, he says they are not going to change the name on the 737 MAX. He's heard people say, look, you won't be able to get people to board this plane once it's recertified. He's saying, look, it's not about marketing. It's about showing people that the plane is safe. That will take some time. They acknowledge that. Guys?
Phil, while we have you, what can we expect from Tesla after the bell?
They are expected to turn a profit, and it's really about the guidance for 2020. So when you look at the fourth quarter numbers from Tesla, unless there is a huge change in terms of where they come in other words, way above or way below, I'm not sure the stock is going to respond too much. $1.72 a share is the expectation in terms of a fourth quarter profit. We're going to be focused on the conference call with Elon Musk. What does he say about China ramping up production? What does he say about the Model Y? Do we still expect it by the middle of this year? And then, of course, there's the guidance for how many deliveries they expect to make in 2020. Remember, last year it was 360-some thousand, a little over 360,000. The streets, the analysts are expecting them to deliver 476,000 vehicles this year. Let's see if the estimate matches that. Numbers come out shortly after the closing bell. Guys?
All right, Phil. China, guys, is going to be a key topic as Google's now confirming they're going to shut down all of their China offices due to the coronavirus. Stocks going into the print, basically at all-time high, $15 short of the all-time high.
Yeah, no doubt about it. You mean Tesla? Tesla. Yeah, absolutely. I mean, I'm not sure what this ramp has been about. It's not really about what's happening this quarter or next. The guidance, though, it's interesting. 500,000 cars was supposed to be the goal 5 years ago for 2018. So now they're going to deliver it today, this year in 2020 perhaps, and it's $105 billion company. And so, it's obviously kind of become a little bit untethered to the day-to-day operations of this company.
Up 120% since the last earnings in October.
Yeah. Of course, China was a big topic last night with Apple. With just about 5 minutes left in the trading day, Apple hitting some all-time highs on the heels of yesterday's earnings. Josh Lipton's been covering that all day. Hey, Josh.
So, Carl, Apple easily beating estimates, and a star of the show, the iPhone. Revenue jumping 8% to $56 billion. Surprising analysts. Services rising 17% to $12.7 billion. That was a new quarterly record, though that did miss estimates. Wearables, home, and accessories surging at 37% to $10 billion. That stock, as you mentioning, touching a new all-time high in today's trade. More big tech news after the bell. Analysts think Microsoft will report Q2 EPS of $1.32 on revenue of $35.7 billion, a jump of 10% on the top line. Guys, back to you.
All right, Josh, thank you. Mike, it was a tough setup for Apple with the run-up into the report. They delivered. So many analysts raised their price targets.
Yeah, they have to chase it at this point. 2%, I mean, for a relatively blowout quarter and an upside surprise on guidance, you'd have to say it's modest, but it's better than a sell the news response. Again, it's another stock that just has this sort of power because of the zeal for huge mega cap, high free cash flow bearing stocks.
Were you impressed with the iPhone revenue?
Yeah, the iPhone revenue. That was a big surprise. That was a very nice revenue beat. I'm long Apple. I think that the only tiny thing was the rate of growth of services. I thought actually for wearables, they talked about being constrained. So I think, obviously people are very bullish on that, but I think some more growth to come there. Valuation getting a little stretched, but I'm hanging on.
Mike has more on the market internals broadly. Mike, what do you see today?
Definitely mixed. Obviously, the market indexes were up a little bit more earlier, but if you look at the New York Stock Exchange advances to decliners, it actually has been up near 1,000 decliners for most of the day, 1,400. So basically, it's break even right now as we flatten out in terms of the indexes. And then if you want to look internally at what has been working and not on the NASDAQ side of things, if you look at the NASDAQ 100 against the equal-weighted version, so the headline's up there because Apple and Microsoft are up, the average QQQ NASDAQ 100 stock is down. Then also a little divergence this month. Software versus semis. Semis are giving back some of that outperformance. This is a month to date. Really has been more of a software story, guys.
I mean, Karen, as far as what's moving the overall market, for so long it was the coronavirus, or for a number of days. It feels like earnings are really taking center stage and starting to differentiate. You've got industrials as the best performing sector today, energy, real estate, and staples. So it's a little risk on, risk off, and a little bit of earnings.
Right. I mean, well, I thought starting with the bank earnings, which were the first ones out of the gate, those were really good, but the stocks had run up nicely going into that print, so they came back a little bit. But I like what we're seeing in earnings. I like some of the revenue beats are so impressive to me, particularly the Apple iPhone revenue beat is very impressive.
About 2 minutes left in trade. S&P's gone red, of course, and the 10-year yield still subdued, 159. Let's get to Rick Santelli. Rick?
Carl, yields continue to drop. The entire curve continues to close at the lowest level since October of last year because the day we're comping had such a big downside range. Look at an April 2017 chart for 2-year note yields. They're low today, 140.8. 139 is that comp in October of last year, but we're only several basis points away from the lowest level since April of 2017. Intraday of 10s at 159 down 7, 1 basis point off the lowest yield of the session. And an intraday dollar index, it closed down slightly, but still holding good gains for 2020. Bertha, it is the second up day in a row.
Yeah, holding up here with Apple, Microsoft at a record high, and Facebook as well ahead of its earnings, getting an upgrade over at Raymond James. Facebook expected to report after the bell $2.53 per share on $20.1 billion. Meantime, chips are sinking. Xilinx and AMD both providing disappointing guidance. Both of these had run up quite a bit, though. And finally, a big bet on online sports betting. Penn Gaming buying $140 million stake in Barstool Sports, getting a big surge on that. Over to Seema.
Stocks pairing gains, Bertha, towards a close with the Dow just barely in positive territory following that press conference with Fed Chair Jerome Powell, where they did discuss balance sheet normalization. Yet a number of standouts within the industrial sector, the best performing sector. Norfolk Southern, that stock at a record high, a big profit beat, although revenue did fall by 7%. LVMH in Europe reporting sales growth that came in slightly lower than expected. The company citing a tax hike in Japan. And there you go, the S&P 500 negative on the day. The Dow Jones Industrial up slightly, 10 points.
And welcome to Closing Bell. I'm Carl Quintanilla in for Wilfred Frost.
And I'm Sarah Eisen, along with Mike Santoli, as always, CNBC senior markets commentator. Stocks finished up the day actually little changed. We saw some of those gains slipping as Fed Chairman Jay Powell spoke this afternoon. The Fed leaving rates unchanged as expected. No major drama or fireworks out of that decision. Though the S&P is kind of closing here around the flat line. Yield slipped, the dollar slipped as well, mostly interpreted as a dovish news conference. The Russell 2000 was an underperformer all day and finished deeper in the red than most of the major averages.
Post-market session's going to be busy on this busiest day of earnings season. Facebook, Tesla, Mondelez, PayPal, Microsoft, all on the way. Las Vegas Sands, too. We'll break down those numbers as soon as they cross.
First, let's talk about the market today. Joining us, Jason Trenner, Chairman at Strategas Research Partners, David Zervos, Jefferies Chief Market Strategist, and still with us, Karen Feineran, Metropolitan Capital President. Let's go to you first, David Zervos. Takeaways from the Federal Reserve and the news conference.
Well, I think it was actually a pretty dovish and kind of almost a somber message, and I think that's why the equity market got a little bit soft as it really read into Jay's remarks. They weren't that upbeat. It was a downgrade of the consumer, and I think a reasonably meaningful one. And I think the change on the inflation language was also sort of a a negative, really, in the sense for the market, in that they're still not able to really see themselves getting to that 2% number, and they feel like they need even more accommodation to get there. So this was not a Fed message that I thought was really, really exciting for risk assets.
Isn't that exciting when the Fed is downbeat on the economy and on inflation, because the translation is more accommodation?
It is if you're long a lot of fixed income, and the fixed income markets did pretty well. But again, the 2-year note's running out of a little room. So what we saw is continued flattening, and we're back to some of the flattest levels we've had in a while. In fact, this year the curve's flattened, depending on whether you look at swaps or cash, almost 20 basis points between 2s and 10s. That's not a signal that's going to go great for the stock market. It's going to be something that says, hey, maybe there's a red flag. So I think I actually do think it was a more somber message. Yes, Sarah, there will be more accommodation coming, but doesn't it sort of take kind of a little messiness to get us there first? Yes. So that may be the reason the stock market's a little bit soggier than you otherwise would have expected with a very accommodative Fed message.
Is this the part where you say don't read into the gut reaction to the Federal Reserve?
Well, the initial reaction was a little bit of upside move, and then we sort of lost it. But I agree, it really was just staring at the yields coming in the way they did. And just to, I agree with David in the sense that it was a dovish message, but it was also one of kind of resignation. It's like, we don't really know what we're doing here on inflation. We're going to wait until it gets up and past 2%, but it doesn't seem like we're heading there. So it was a kind of a low and slow type takeaway. Don't want to build in too much meaning to an hour and a half's worth of market action, because yesterday's bounce in the market was a little bit mechanical and just got us up into this neutral zone. So we might just be still in chopping pullback range in a shallow way at least.
You agree with the somber assessment? He said coronavirus is serious, still said looking for signs manufacturing's recovering.
I think the somberness really comes from the fact that the 10-year Treasury yield is lower and the curve is flattening. Now, part of that could be for things that are pretty transitory, whether it's coronavirus. But I think, the Fed was probably looking forward to having a year where it didn't have to do much after it eased 3 times last year. And now you're in a situation where the curve is flattening again. It may be forced. And the Fed makes a distinction between a flattish curve and an inverted curve. By the same token, they want the curve to be steeper. They want 10-year Treasury yields to be stronger. And of course, now that you have trade behind you, I think everyone was looking forward to a stronger global growth profile for this year. I know I am, but it may take longer to get there. And that may be part of the reason, maybe what David is picking up, same thing I'm picking up, which is you want it to be the real thing.
All right, we're going to continue that discussion in a moment. Let's check in on how Las Vegas Sands is doing post-earnings. I think we're going to contest that, right?
Yes, that's right. Hi, Carl. You know what we're missing here on revenue? It came in at $3.51 billion versus the estimated $3.36 billion, but a beat on earnings per share at 88 cents. What was expected was 78 cents a share. We know that there was some increased corporate expenses coming into play here. We're dialing down on the Macau revenues. The estimate for revenues was $2.25 billion, and we know that adjusted property EBITDA was $811 million. So we need to get those figures compared. And a lot of focus here on the call coming up is going to be on coronavirus and the impact that it's had on Macau and now on Marina Bay Sands, because of course Singapore has cases of the virus as well. As you can see, the shares in extended hours up 2%. We'll drill down into the details.
Facebook first. Contessa, thank you. Want to hit Microsoft now. Josh Lipton with those results. Josh.
Sarah, Microsoft reporting Q2 EPS here of $1.51. That's versus expectations of $1.32, and revenue up 14% to $36.9 billion versus expectations of $35.7 billion. So beats there on the bottom and the top. Just turn to the segments here. Revenue and productivity and business processes, $11.8 billion. That is an increase of 17%. Within that, Office 365 commercial revenue growth, 27%. Revenue Intelligent Cloud, $11.9 billion. That's an increase of 27%. Within that segment, Azure revenue growth, 62%. And finally, revenue in more personal computing, $13.2 billion, an increase of 2%. Within there, Windows OEM revenue increasing 18%. Conference call kicks off at 5:30 Eastern, guys.
All right, and you're seeing a pop in the stock. Thank you, Josh Lipton, up more than 2% after hours. We're going to talk about all those earnings movers. They're going to be on the side of your screen throughout the market zone. But first, we've got to hit President Trump signing the USMCA into law today. And joining us in a First on CNBC interview is Peter Navarro, White House Director of the Office of Trade and Manufacturing Policy. Welcome, Peter. Nice to see you.
Hey, Sarah. Hey, Carl. What's going on?
So tell us a little bit about how you're thinking about the economic growth. The president said more than 1% as a result of the USMCA. How do we get there?
Yeah, so Michael was talking about short hits. This is what we put in place today was a long-term economic driver. And I think the most important thing to know about USMCA is it's designed to reestablish North America as an auto manufacturing hub for the world, with Detroit as the center of that universe. And the beauty of USMCA is it's got these tough regional content rules coupled with strict environmental and labor protections, which will make sure the U.S. and Detroit gets its fair share of auto manufacturing. And then, in addition to that, we've got really nice things for agriculture. Dairy farmers in Wisconsin are going to be able to scale the Great Walls of Canadian production. We're going to see a lot of things in terms of north-south trade down the southern border. And tomorrow, the president's going to get on a plane and go to two places symbolically, Michigan and Iowa, that I think bracket this idea that this agreement is great for all 50 states, and farmers and auto workers and manufacturers are going to benefit. So this will be a nice pulse. The numbers on this in terms of growth, 75,000 auto jobs, a couple 100,000 jobs overall, some growth in terms of real GDP. So great day for the White House. I remember back in 2016 in June when candidate Trump gave his famous jobs plan speech outside of Pittsburgh, promised to renegotiate NAFTA. This is promises made, promises kept for Donald J. Trump.
Very important signing today, Peter. You're absolutely right. Not to jump too quickly to the impact of the coronavirus, but obviously there's the fear that it's going to unwind some of the potential benefits of phase one. Sonny Perdue today said he didn't know whether it would affect ag commitments. How much are you worried about that unwind or potential unwind?
Well, we have a really strong leadership with Secretary Azar and the CDC. We're working very carefully and diligently on this. So let's see how this unfolds. This is not my lane per se, so I'm going to let others come on CNBC and inform that.
I mean, the whole thing with both the USMCA passage today or signing by the president and phase one China is that it removes the uncertainty for business. And so investors and economists are expecting a growth pickup just from that alone. Why leave the tariffs in place if you're hoping to create growth as a result of these trade deals?
Sure. The China tariffs have been tremendously successful in two things. One is defending American technological crown jewels against Chinese economic aggression. And two, they act as an insurance policy to make sure that China comes to the bargaining table to sign phase one, but also comes back to the bargaining table to sign phase two. And remember, what we didn't do in phase one is deal with China's unfair subsidies and state-owned enterprises, which to this day hammer American industry and American workers. And the tariffs themselves basically act as countervailing duties against that economic aggression. So what President Trump has done is put into place a system and a process where we think over time we can get to a great place.
Well, Peter, if it's evident that the Chinese are working in good faith, even with the challenges of the virus, is it possible you could see tariff rollbacks on the part of the White House as a stimulus mechanism to help them out?
That's a spin that's coming right out of Wall Street, and it really, I think it does a disservice to this whole crisis to bring that into the discussion.
So that's a no.
Well, again, let's remember why the tariffs are in place. The tariffs are in place because China engages in massive unfair subsidies. They use their state-owned enterprises to put American companies and workers out of business. And the tariffs also ensure that we come back for phase two. I think what's really important here is, like, we got a great phase one deal. Everything's moving forward, and I think what we need to do is to talk about progress in USMCA and all the good stuff instead of dwelling on that kind of question at this point in during a crisis.
Well, one place that people are looking next is Europe as a trade target, and we know that the president has said that he would impose auto tariffs if the Europeans don't make a deal. What's your expectation at this point about whether we're going to see those tariffs?
So let's just step back and understand President Trump and how he works with trade policy. For example, Mexico we had a tariff issue with Mexico, and the next thing we knew, they did more in 2 days to help us with border security than they had done in 20 years. As the president has talked about, 2020 has to be the year where we come to some kind of understanding with Europe that they can't keep treating us so unfairly. Our trade deficit with Europe is approaching $200 billion a year. It's absolutely insane for Germany to be able to charge a tariff on American autos, which is 4 times higher than what we're charging on them. And those kinds of unfair and non-reciprocal relationships with Europe are endemic and systemic in the system. So what the president is trying to do with Ambassador Lighthizer is to work with the Europeans and say, hey, all we want to do, all we want here is fairness. And now we're gonna basically try to get that with the tools we have at play.
Peter Navarro, thank you for joining us.
My pleasure.
The presidential advisor on trade in support of the USMCA. Facebook earnings are out. Let's get to Julia Borston with those results. Julia.
Sarah, yes, earnings and revenue both beating expectations. The company reporting earnings of $2.56 per share. That's 3 cents better than estimates. Revenues coming in at $21.08 billion versus $20.89 billion estimated. We see the MAU, the monthly active user and daily active user numbers also coming in just a hair stronger than expected, pretty much in line. 2.5 billion monthly active users, 1.66 billion daily active users, and average revenue per user also stronger than expected at $8.52 per user. That's up from $7.37 last year per user. So that average revenue per user metric is growing. Also, news just crossing the wires that the company has also announced a share buyback program, an increase of a $10 billion authorized under its share repurchase program. We're going to dig through the slides here and look at some of the numbers for the different regions, which are always important. We'll be back to you with more.
All right, Julia, thanks for that. Mike Santoli, is this what happens when you don't absolutely crush the estimates?
That's definitely part of it. I mean, it was just within the range of the estimates. Within the numbers, I mean, revenue growth looks great. It's still another reminder that expenses are ramping at a very rapid pace year over year. Costs and expenses up, 34%, and margins therefore down 400 basis points. So I don't know that that's unexpected, but it does sort of show that they have less earnings leverage. Maybe they're past the big bulge in ramped expenses, but I do think that's part of the reason as well.
Karen?
Yeah, I mean, it's expensive, but this is one where you really want to listen to the call, right? Not just look at the numbers. Let's hear why. What happened with the expenses that really caused the sort of the miss here? The other thing, the share repurchase was an additional $10 billion on top of what already, if they used the money, would be a pretty significant buyback. And so I don't know if they'll talk more about that, but I think that there was $24 billion before. So that's significant if they use it. I really want to hear, though, what happened on that expense line.
I'll just hit Mondelez results because they're also out. The giant global snack maker with a beat on the bottom and top lines, reporting 61 cents adjusted. The estimate was about 60 cents, so beat there. Also on revenue, $6.91 billion. 6.8 was the expectation. Some nice organic growth of 5%. So they continue to show that they are outgrowing the entire packaged food industry, outgrowing rivals like a Kellogg, for instance, or a General Mills. And part of that story for Mondelez is the global exposure. They get 80% of their revenues outside the U.S., and also the snacking business continues to be strong. They own Oreos and Nabisco and other power brands, which continue to drive the quarter. By the way, we're going to talk exclusively to Mondelez CEO Dirk Van de Put on this show tomorrow about these results. But clearly, the market continues to reward this stock.
Yeah, without a doubt. It's a standout in the group. People's eating habits, some would say not good, but they're good for Mondelez, right? So I think that's probably what the
Well, they did make the
what
Oreos
takeaway
thinner.
is.
So.
It's true, yes.
They made the Oreos different in about 100 different ways. We're in the thick of earnings now, right? Looking okay to you?
Yeah, I mean, you look at, you look at Microsoft beating and you look at Mondelez beating, right? You have a consumer staple stock that's trading at 24 times earnings, and you have a technology, a software company. I think one of the things that Mike mentioned before, I would argue is a little disappointing, maybe goes back to what we talked about in terms of the yield curve, is that the cyclicals, the pure cyclicals, are not doing as well, right? So you're back to almost a TINA sector play where things that have very high growth do very well and things that just have yield do very well. And I'd like to see it broaden out. But listen, as Karen said before, the earnings season is coming in better, I think, than people expected. And it's hard to get too negative given where interest rates are and earnings are.
Julia Borston's been digging through Facebook, and she's got more for us. Julia.
Yeah, Sarah, with Facebook, we're always interested in knowing how much the company has really hit a limit to its growth in the U.S. and Canada. In the U.S. and Canada, the company added 1 million users between the third and fourth quarter. So ending the fourth quarter with 248 million, up from 247 million. Now, in the prior 2 quarters, the company had added many more. And remember, this was an issue back a year ago, and user growth was flat between Q3 and Q4 last year, and then they started growing again in the U.S. Between Q4 and Q1, but it's notable that growth slowed in the U.S. and Canada to just 1 million additional monthly active users, and those monthly active users are usually stronger than daily active users. Also want to note here that the company is stressing their daily active people for Facebook's family of apps. They're really trying to shift focus not just to Facebook, where the growth is slowing, but to also include Instagram, Messenger, WhatsApp, and focusing really here on what they're calling family monthly active people, a new metric, saying there were 2.89 billion monthly active people using Facebook's family of apps, so trying to shift focus there. And we see Facebook shares down almost 6.5%, but it is worth noting that Facebook shares were up over 50% in the prior year leading up to this. Guys, back over to you.
Julia Borston, 2.5 billion is roughly, what, a third of the global population?
Yeah, that's it. I think it's closer to like half of whoever owns a smartphone.
Yeah, crazy. Well, we'll wait for that call, as Karen said. Thank you, Jason Trennert, Karen Feinerman, and David Zerbos. Up next, we're going to dive more into Facebook earnings. Plus, we will talk to our closing bell closer, DraftKings CEO Jason Robbins. He's here ahead of the big Super Bowl weekend. So keep it right here on Closing Bell. We are back in just 90 seconds.
Yes, I'm stuck in the middle with you.
No one likes to feel stuck, boxed in, or held back, especially by something like your cloud. It's a problem, but the IBM Cloud is different. It's open and flexible enough to manage all your apps and data securely, anywhere, across all your clouds. So it can help take on anything, from rebooking flights on the fly to restocking shelves on demand, without getting in your way.
Everyone loves the benefits of compression socks, but they're just so hard to get on. Until now. Introducing the all-new Copperfit Energy Socks, the first ever easy-on, easy-off fit to help reduce swelling, relieve tired, achy muscles, and provide energizing support.
Being a SWAT commander, we train to win. The Copperfit Energy Socks, they didn't feel like other compression socks. They totally exceeded my expectations.
Copper-infused fabric woven into our compression sock to help reduce swelling discomfort.
They just slip right on, yet they still have that same compression that you want.
Extra support around the arch and ankle for relief of muscle aches and pains.
These were fantastic. A lot of compression socks are a little too thin. I could wear these every day.
Feel more energized. Get your energy socks now online at GetEnergySocks.com or call 1-800-377-9502. Order now and get a second pair free.
I have so much energy, I can go. Hey, you want a dad?
Copperfit Energy Socks.
Earnings are flying tonight. We've got Tesla a little earlier than expected. Let's get to Phil LeBeau. Phil?
And Carl, we have Tesla beating on both the top and the bottom line, and beating by a wide margin on the bottom line, earning $2.14 a share in the fourth quarter. The estimate on the street, $1.72, so well above expectations there. Revenue also coming in better than expected at $7.38 billion. The guidance is what everybody's focused on. Remember, they delivered 360,000 vehicles last year. Wall Street was expecting them to say 475, 476,000. Tesla saying it will comfortably exceed deliveries of 500,000 vehicles in 2020. The Model 3 ramp is taking place right now in Shanghai. They expect Model Y production in Shanghai to begin in 2021 and limited production of the Tesla semi-truck later this year. Finally, solar and storage deployment. That's a part of the company that doesn't get a lot of attention. They expect growth of at least 50%. But guys, I think a big reason that stock is moving higher, not only beating on the top and the bottom line, but that guidance for deliveries in 2021. Tesla says it will comfortably exceed 500,000 vehicles. Guys, back to you.
612 in the aftermarket. Thank you, Phil. Mike Santoli, they do say 2019 was a turning point. Billion in operating cash flow in the quarter. It's less CapEx, but the right direction.
That's like a free cash flow type number that they're using, right? And that is, without a doubt, the biggest change right here, where they're building cash as opposed to burning it on a net basis, at least for now. And yeah, the 500,000 plus guidance for deliveries this year is the big number. That was, as I said, it was a big round number. You went back 5 years, said we're going to get there in 2018. We know about all the stumbles. This year seems to be good enough to keep the story rolling.
Still, I mean, the story rolling, but the valuation, so hard to figure. This was a $200-something stock in October.
Yeah, it's closing in on 600, and we're still talking about a 5% operating margin, right? It's still a moving metal business, even though they're doing it arguably in a more efficient way once they get to full scale.
Although they would point to automotive margin, which is now 24.3, up from 18.9 in Q2.
Without a doubt.
PayPal earnings are also out. Kate Rooney with those numbers. Hi, Kate.
Hey, Sarah. So PayPal shares taking a hit after coming up light on Q1 guidance and total payment volume. Start with non-GAAP EPS, though, was a beat by 3 cents. Revenue also above expectations. Total payment volume, it's a key metric for PayPal. They also call it TPV. That was slightly short, 199 billion. Street was looking for 202 billion. We did get a rare update on Venmo. 52 million users are now on that peer-to-peer payment platform. That's up from 40 million early last year. The company did raise full-year guidance. That's partially thanks to the acquisition of fintech company Honey that closed in January. Call is coming up in about 40 minutes. We'll be looking for any details on Venmo profitability. Guys.
All right, thank you very much, Kate. Talk about PayPal, Mike, to the degree we know they've had challenges of sorts.
They have. Stock has, made a decent comeback, almost toward new highs, but revenue basically being on target. So really no more top-line momentum than the Street was looking for. To me, that's my, first very high-level interpretation of why the stock would trade down like this, except that it's very high expectation stock, and so many people just think it's a no-brainer to crowd into everything in electronic payments.
All right, we'll watch that one. Facebook, as we said earlier, down sharply after hours, despite that top and bottom line beat. Joining us to break down some numbers, John Freeman's Vice President of Equity Research at CFRA. Kevin Landis, First 10 Capital Management CIO. Guys, it's good to see you both. Good afternoon.
Thank you for having us.
Kevin, I'm seeing some numbers here on FX neutral ad revenue growth, maybe a little shy. Are you seeing something else?
Well, we haven't gone through all the numbers yet, but what I'd say is that it's basically an up and to the right story, and the whole micro-targeting, the power of micro-targeting is still early on. So even though their users aren't ramping up that fast, they should still be able to ramp their revenue pretty aggressively.
John, what do you see that explains a 7% down move this afternoon?
Yeah, I just think maybe expectations got a little bit ahead of what was plausible, because certainly it has had a run. Facebook has had a run recently. I thought the beat looked pretty solid, actually. I was actually surprised. I was looking for more like 7 to 8% MAU and DAU growth, monthly active users, daily active users, and it actually was a little higher there. So I thought that was actually impressive. And ARPU growth obviously is something that is going to be more and more important, because the U.S. we make Facebook makes $34 a user, and in rest of world I think it's like $3, like a 10x difference. So there's a lot of room for that to kind of at least catch up or make some progress versus the U.S. And I think that's looking pretty solid, and I'm fairly optimistic about that going forward.
Now down 7.3% after hours, Kevin. So is this a buy the dip opportunity for Facebook after a 60% run up for the stock last year?
Maybe. Remember, it's a mega cap name already, so you're not going to get outlandish moves. But we're still early in this story playing out. So they're on their way to becoming, even bigger and more scary than they are today. I certainly think that the fundamentals are going to keep going, like I said, up and to the right for the next 2, 3, 4 years. So if you're looking for an entry point, today's not a bad one.
Kevin, in general, what's your view on FANG-related names, mega cap tech, given the run they've had, where we are on global yields and so forth?
We took a bit of a beating last year by being a little early to de-emphasize those FANG names, FANG and the mega cap Apple and Microsoft as well. So the point that I make there is that once you get close to $1 trillion market cap, it's a little tough to say you're going to double your money in these stocks. And so we have kind of emphasized the faster growing sort of mid-cap growth names. But, that was bad advice last year. You would have been better off to ignore me a year ago.
Right. Well, watch this one. Obviously took some time to break above 200 and still above that at 206 and change. John Freeman, Kevin Landis, thank you, guys.
No, thank you.
Thanks.
Tesla shares taking off after a big earnings beat. We'll talk to someone who sees Tesla hitting $6,000 a share. That would be our capital. Everybody knows that. Coming up.
And as a reminder, you can always watch or listen to us live on the go on the CNBC app. Closing bell returns in a moment.
Make fitness routine with Pure Protein.
High protein, low sugar, tastes great.
High protein, low sugar, so good.
High protein, low sugar, birthday cake.
And try Pure Protein Delicious Protein Shakes.
Do you have concerns about mild memory loss related to aging? Prevagen is the #1 pharmacist-recommended memory support brand. You can find it in the vitamin aisle in stores everywhere. Prevagen, healthier brain, better life.
Interactive Brokers pays 1.06% on idle cash in your brokerage account. Do you know what your broker pays? Most U.S. brokers offer nominal interest in their brokerage accounts. Move your account to Interactive Brokers and start earning interest.
It's time to get invested!
I pledge.
I pledge.
This is the year.
I get invested.
Are you ready to take a stand and invest in the things that matter most to you?
My retirement.
Student loan debt.
A better life.
For my American dream.
My American dream. Get invested.
Share your voice. Take the pledge. Get invested.
The time is now. Now. This is my pledge.
My pledge.
My pledge. Get invested.
Invested.
Go to CNBC.com/invested now to take the pledge.
Whatever job you're searching for, you can find it on LinkedIn. First jobs, flexible jobs, keep me out the cold jobs, advertising jobs, accounting jobs, HR, PR, even ER jobs, East London jobs, West London jobs, extra hour in bed jobs, startup jobs, late start jobs, get home in the daylight jobs, banking jobs, building jobs, flexible working on a Friday jobs, or even voiceover jobs, which is how I ended up recording this ad. Search millions of jobs on LinkedIn and find one meant for you.
Keys. Check. Phone. Check. 70s playlist downloaded. Check. Nice. There's one more thing you should check before you leave. Your travel. There's a new cycleway under construction between Kensington Olympia and Brentford Town Centre, so expect delays due to lane closures at the junction of Kew Bridge Road and Chiswick High Road. Plan ahead at tfl.gov.uk. To the Mayor of London and TfL, every journey matters.
He commands the offense. Who are Wall Street's quarterbacks? In this market, it's got to be the software industry, which has been responsible for a tremendous portion of our overall gains for the past decade. Watch or listen live on the CNBC app.
Tesla shares popping after an earnings beat, both on the top and bottom line, sitting at $616 per share. They're $618 now in the after-hours trading. This was a stock trading below $200 back in the summer. Joining us now is Joe Osha of JMP Securities, Jed Dorsheimer of Canaccord Genuity, and Tasha Keeney of ARK Invest. Tasha, first to you, the mega bulls on Tesla. So I assume you're pretty encouraged by this report. What stood out to you? Yeah, well, I think the auto gross margin was higher than most expected. I saw estimates in the sort of early 20s range. It's at 24%. I think that goes to sort of prove our thesis that we think with Wright's law, the way that we've modeled battery cost declines, that Tesla's costs should continue to come down while traditional gas-powered vehicles are just becoming more expensive to produce. And this is what's really going to drive the inflection with electric vehicles. We think that they'll be at price parity with gas-powered cars by the early 2020s.
That reminds me of what Elon tweeted earlier this afternoon. This was a blog he wrote in 2006, where he said the master plan is to, one, build a sports car, use that money to build an affordable car, use that money to build an even more affordable car. Joe, is this all going to plan, and are we really on track to 1.5 million?
Well, I will say that we had for this year, we had them at above 500,000 units. I think they're making tremendous progress in terms of the manufacturing ramp and the market share that they're gaining. My question is really more to do with what you want to pay for it. Even on our numbers, which I think is where the street's going to be coming to after today, you're paying a mid-20s EBITDA multiple. I'm not sure I can get comfortable with that, but all credit due to the company. They've done amazingly well.
Hang on, everyone. We've got a news alert here on Delta. Phil LeBeau with the details.
Sarah, much as American and United have both said that they are going to be reducing their flights or canceling flights from the U.S. into China because there's just been a drop-off in the number of people who are going to China, Delta is now doing the same. Starting February 6th, it will cut the number of flights between its hubs in the U.S. going to China from 42 a week down to 21 a week. So basically cutting it in half. That is from February 6th all the way through April 30th. And again, this is much like American and United. There's just a big drop-off in the number of people who are flying, especially corporate customers. Therefore, Delta is going to cut back its schedule to China.
All right, Phil, thank you. Keep us posted on all those changes to travel. Let's stick with our panel, Jed, and get back to what we were talking about, which was strong results from Tesla, strong guidance and margins, and how you balance that with a share price that has already exploded and questions about the valuation.
Yeah, I mean, I think we got all the questions on profitability as well as demand answered. I think the risk factor on a go forward, and hopefully Tesla will be able to address this, is, what is the virus going to do with respect to Chinese demand? Is the Shanghai facility is clearly a big component of the growth story going forward. So I think right now we're just going to need to see, more information in terms of constantly evaluating. I would say that one of the challenges, and I think the problems with taking a traditional metric approach to a company that's far out in the lead of a new space, often we get into these situations where valuation metrics are maybe not applicable in the same way they are to a GM or a Ford. So I do think we need to look at this stock differently.
Although the bear case would be that eventually it does get valued like a traditional OEM. Or is that rule broken now, Tom?
Sure. No, I mean, listen, that's sorry. I thought you were addressing me.
I think he has a good point that I'd say the traditional valuation metrics are broken in that, one, this is an electric vehicle company. It's not a traditional auto company. I think that market's going to consolidate as electric vehicles and autonomous vehicles come into play. And Tesla's really the leader in both of those markets. And especially if you consider the autonomous opportunity, which we think is measured in the trillions as a market globally. Tesla, I mean, this is a big market for Tesla. It's going to get higher margins, and it's going to help with that multiple. So it should be valued at more than a GM or a Ford, who are further behind on both of those fronts. How do you think through the multiple?
May I offer some perspective on that? I don't disagree. I guess the question would be, do we value it like GM or do we value it like Facebook? We're not talking about a 10 EBITDA multiple here. We're talking about 25. So I do agree that comparing this company to General Motors doesn't make sense. The question is, what is the right multiple?
All right,
well, you're also comparing it to...
No, go ahead, Jed. Last word.
I was going to say, we're also comparing it during the growth phase. I mean, we've had these same arguments with respect to Amazon and Google 10, 20 years ago. I mean, I don't want to point out how old I am, but we've been through a few of these cycles. And this is the value of being able to capture one of these early leaders.
Jed, Joe, and Tasha, thank you all. Thank you. As Tesla soars after hours.
Still ahead, our closer today is DraftKings CEO Jason Robbins. Find out how much money Americans are betting on the Super Bowl on Sunday. It's later on Closing Bell.
You know that tech stock we talked about? I picked up 500 shares.
You get in at a good price?
Oh, yeah.
Schwab saved you how much?
It's time to trade up to Schwab, where you get price improvement on 95% of orders and commission-free online trades.
I'll take care of this.
Are you getting complete price transparency? Expect more from your firm. Schwab, the better place for traders.
Pain, swelling, stiffness. When your hands hurt, you can't function. Until now. Introducing the new Copperfit compression gloves with sure grip technology to give you more power, more control, and more agility than ever. Our